Senator Ron Wyden, he's the leading Democrat on the Senate Finance Committee, is proposing a new tax on the investments of the wealthy. Now, the plan would call for taxing long-term capital gains every year, as opposed to the current capital gains tax, which taxes assets only when they're sold. Now, the plan, known as mark-to-market, would also tax capital gains at the same rate as ordinary income. So the top cap gains rate right now is 23.8%, and the top rate for ordinary income is 37%. Now, details won't be released until later this year. Wyden's office saying the tax would eliminate serious loopholes that allow some to pay a lower rate than wage earners, to delay their taxes indefinitely, and in some cases to avoid paying tax at all. Now, the loophole he's referring to there is families that have an asset or stock that is passed to their kids or to charities without ever paying a tax on the gains. Now, analyses of similar plans show they can raise over $125 billion a year, so that's why they like it. There are a few problems. It has little chance of passing a Republican Senate, and a big challenge will be how to value the annual change in assets, especially illiquid assets like private companies or real estate. There are also questions over how to handle losses and, of course, taxpayers who don't have enough ready cash to pay the tax on illiquid assets.
On paper gains, on all of this stuff,
gains,
too, that you may not ever see. Look, there have been a number of kind of ridiculous ideas that have come out, that have been populated out there. We've talked about a lot of them. But to this point, they've either been freshmen in Congress, or they've been people who are running for president and who want to get an attention. I think this is different because it comes from the ranking member on the Senate Finance Committee. What's happening? He's proposed
sort of similar ideas before that have gone nowhere. I think his real goal here is to get the idea of an increase in the capital gains tax into the mix of the 2020 elections.
Let's get the conversation started. Just like the New Green. That's what they say about all these things. No, we don't mean any of this, and we certainly don't want to vote on it. We'll vote present. But let's get the conversation started.
So it's just a negotiation where we're saying we're going to make up something ridiculous so we can get to what we want.
We've had a proposal for the wealth tax. We've had a proposal to increase the income tax. And we've had a proposal for the estate tax. The only tax that hasn't been proposed by any of the candidates is a capital gains tax.
Well, just say that. Just say that if that's what you want to talk about, instead of making some ridiculous, like, unenforceable.
Well, sometimes in Washington you have to go here to get here. I think that's
so retired people that already can't get any income in CDs because rates are so low now are living, a lot of them, off dividend income from stocks. So you're going to tax them on the stocks that they're holding. They have no money anyway. You're going to have to sell the stock to pay for the taxes, and then the stock goes down the next year, and you don't even have the gain anymore.
I'm not suggesting.
No, I'm just saying. You know, I don't like to get emotional, but if you don't suffer fools, it's tough to pay attention to politicians. So if you have trouble suffering fools, it's really difficult.
So let's start by suggesting that the senator had good intentions. I believe he had good intentions.
Where do they usually lead? Where do they pave the path to, John? 90% of the time.
I think you have good intentions, Joe, even though every now and then you say something unintelligent. It's very rare. It's very rare. It's very rare.
Let me know.
It's very rare.
Can you bring up an example?
Now, so look, we don't want to be France economically, and we don't want to be Venezuela economically. We got to find a common ground forward. When we were on the show the last time, you raised something which initially I didn't think was a great idea, but I really didn't understand it. I think it's almost the same conversation.
Exactly.
Right. So you talked about philanthropy.
Yep.
And I thought you were talking about taxing me, and I have a hard enough. I got too much money in my money. I'm trying to attract capital. You were talking about the wealthiest of the wealthy who take money, set it aside into a commitment for philanthropy, but that money sits there forever, that it untaxed but unused. And I think so we can find a common ground here. We want to not be focused on what we're against, but what we're for. What we're for is get that money either into investments 100%. Or into philanthropy.
What if it's used? What if it's forced to be used in 7 years, as Buffett's donations are forced to be used?
Perfect.
I mean, does that take it out of the equation?
As long as you're using that money as a force for good or a force for investment, then it should be untaxed. But if it's sitting there, parked somewhere, then you should be disincentivized from having it sitting there. To this point, if you invest in, let's say, small business, you're the top 10%. That's what we're really talking about here. And you're investing in your capital, some of your capital gains in small opportunity zones. Then maybe you get a 4 times capital gains set aside. You're not taxed because you're doing this good thing over here that, by the way, is good for you and good for America. Okay, now I think we're sort of getting into the right direction. I think this is a conversation starter. Joe, I'm trying to take your heart medicine so that it doesn't get you, or all worked up.
The big issue, though, there was a time.
Joe's completely turned
There
off.
was a time during Ronald Reagan's presidency where the capital gains tax was the rate was equal to the ordinary income tax at 28%. And those diverged and have continued to diverge. And there are many people, including Heidi Heitkamp and other sort of more moderate Democrats, who feel that work should be taxed the same as money.
I agree. We should lower the ordinary income rate down.
That could
lower the ordinary income down to capital gains.
That could be the answer, too.
Explain your situation.
Yeah.
That could be the answer, too. But I think that's sort of the core issue. And I do agree that this mark-to-market issue has sort of strayed to the other end.
We have a lower capital gains rate, not to reward people that own the assets, but to try to incentivize capital investment. And if it's fine to have the conversation, here I go, about whether you need to raise capital gains, but just make sure you understand what the unintended consequences could be. That once again, are self-defeating from the end result you're trying to get to help the people that you're trying to help. I'm not sure you get there.
So let me say this. Some people say, I hate rich people. It's not true. You hate rich people until you become rich. What people hate is a game system.
Yeah.
What they hate is that they say, no matter how hard I work, I'll never succeed. So that's what's really underneath this, is that sense that I'm never going to be there, so I'm going to tax them.
So in your view,
we've got to create a ladder. Go ahead.
In your view, is there anything about the tax system that can change that?
There's a lot of things. I mean, let's just start with, let's create an incentive, I'm going to get on my bandwagon again, for internships, for apprenticeships. So you can avoid taxation if you massively invest, I'm not talking about tokenism, in internships, apprenticeships at scale. That's great for America. By the way, after World War II, that's what saved this country. Was people coming back from World War II.
And by the way, they should be paid internships, so it doesn't only go to people who can afford to not get paid for their summer.
Although I would intern here for free because I get relationship capital hanging around Joe.
Yep.
And by the way, relationship capital is as valuable as financial capital.
But the reality is there are a lot of kids who cannot afford to not work for the summer.
Agreed. Agreed.
But there's nothing on the actual tax. I mean, this goes to the other question, which is the tax system itself creating the inequality?
The tax system is not creating enough opportunity. Right? We're focusing on penalizing, not incentivizing.
I think Wyden should have. I understand that when you die, if you've never been taxed on a huge appreciation, that if you want the government to get its share of everything that happens in your life, then figure out a way of doing that, whether it's through
that would eliminate the step up.
That's what I mean. If you want to do something like that, but don't do something.
That seems like a pretty simple fix.
Don't do something that's
we've been talking about that for a long time.
Do you think that's the right way to go?
I think that's the easiest and most effective way to do it, and
patently stupid like this.